We're going to go ahead and get started. Today is Monday, September 18th, 2 p.m. section. This is section 201. This class is being recorded. We post it online. Here is the sign-in sheet. Please make sure you sign the sign-in sheet today. Start on this side of the room. In just a few minutes, we're going to start going through lecture note 2, so you might want to have that handy. It's in the files section as we start the second content section of the class. But I want to mention a couple of things before. First, 2 weeks from today will be your first group project presentation on EIC. Okay? Basically, each of the 6 teams and all the sections will do a 10-minute presentation on an EIC on a company that I will give later today. Okay? So based on that, you'll go through the E, you'll go through the 5 forces today, future, you go through the competitive advantage today, future, referencing your screenshots. The company you get will also be in multiple industries, so you'll have to have multiple industry analysis, and you'll have to get it all done in 10 minutes. If you go past 10 minutes, I will stop you, and anything you say after that will not be graded. Okay? Just out of fairness to all the teams. So 10 minutes means 10 minutes. Okay? Give you like maybe 10 seconds to wrap up, but it's a hard 10 minutes. Right? So that is the PowerPoint presentation, group project. You might want to start working on that, as I said, 2 weeks from today. I'm also going to trial something that I did in my MBA class this summer, which worked so well. We're going to try it with you guys. That PowerPoint presentation is worth 10 points. Okay? 80% of the grade that you get during class for that presentation, that group project, will come from me. 8 of the 10 points. The other 2 points will come from one of the other 6 teams in this room that will grade you. So in addition to presenting that day, you as a team will grade one of the other teams presenting that day, and that will be 20% of their grade. Okay? So I'm 80% of your grade, your peers are 20% of your grade. You're also subject to peer reviews to make sure you participated in during the project. Okay? So that starts with the EIC presentation, and I plan on continuing that for the remaining 3 presentations this semester. Okay? Questions about any of that? Yes?
Will we be given a fixed criteria to be grading them on?
Yes, but it's no different than homeworks 2 and 3, meaning you got to cover the E, you got to cover the 5 forces, current and future, you got to cover the C today and tomorrow. That's basically what the criteria is. The only difference is it's verbal as opposed to written. You got to use numbers, but I'll put more of that online. Other questions? Okay, great. So the other thing I just want to briefly talk about is homework 3, kind of a repeat of homework 2. In the interest of time, I'm going to go through it relatively quickly. But the idea is you did your EIC on RTX. So for RTX, first thing you would have done is you'd have gone to RV. And you got a markets beta. And you'd have gone to defense. And based on the raw industry beta and RTX's beta, you'd have started to address the E. High level, with a 0.73 industry beta, this industry, defense, is less sensitive than the average company to changes in the economy. Okay? And RTX, with a beta of 0.64, is even less sensitive than the average defense company. Right? And then you would have given some rationale on the E side. Basically, what happens in the defense industry is they're usually tied to government spending, and government spending doesn't go down 10% a year, it doesn't usually go up 10% a year. So government spending, even the fight we're having today in the U.S. about funding next year, we're fighting over 2%. Okay? And so basically, the defense budget, which has been fairly stable over time, generally allows these firms to get past most of the economic conditions, right? And the other thing that tends to happen on the defense side is they tend to sign long-term governments with a contract, multi-year. called programs. And so the idea is I'm going to build a missile or a jet over 10 years. Okay, so the funding I get is for a 10-year contract. It's not year by year. That tends to mitigate some of the economic volatility of this industry on the defense side. Okay, you'd have jumped over here, taken a screenshot, and submitted on the aircraft side, and you would have said, this industry has a slightly higher beta at 0.585 than the defense. Okay, but here's the kind of asterisk. RTX is a big company, and the RTX is the average of both sides of its business. And it's kind of making this industry look even less sensitive than it probably is. Took RTX out of this, the beta is going to be closer to 1 for the industry. Okay, but the point is, it is a little bit more economically sensitive to changes than the defense industry. If you just use the screen, you'd say it still is not overly sensitive. Now here's what's been going on. Okay, first, in times of COVID, airlines bought less planes, right? And if they're the supplier to the manufacturers buying the planes, then that's why some of the other suppliers in this industry tended to have higher betas, right, than RTX, because they don't have the defense side, right? And so the business was a little bit more volatile because of what happened with COVID. And coming out of COVID, airlines are now starting to buy a lot of planes because they expect global demand to come back. They need more aircraft. That tends to drive more spending. But that's the point. This industry is a little bit more sensitive to defense because of the boom and bust cycles, which are tied to the economy. Boom cycles generally get more aircraft demand. Bust cycles, less aircraft demand. This side of their business is somewhat more sensitive than the defense side to changes in the economy. Now, given the data on the screen, if you said still less sensitive than the company, that's okay. But realistically, it is a little bit more sensitive. It's kind of closer to the economy when you take out RTX, right? Now, that's the E. 5 forces. You'd have gone to custom spread, and you'd have started out, I'll start here, with either the aircraft or the defense. They both have negative spreads, okay? So you'd have used the negative spread, starting with aircraft, of about 8.66 WAC against a 6% ROIC, okay, so that's a negative spread. And Raytheon spread, 8 minus 3 ROIC, is worse. They don't demonstrate competitive advantage right now, okay? So basically, back to the 5 forces, that's the point. In today's world, you can see this in SPLC. And by the way, there's a negative spread on the defense side as well, right? But this is the supply chain for Raytheon, RTX. Their biggest customer is the U.S. government, which represents 43.5% of their sales last year, okay? That's the numbers on the top right. So that's the point. Like, when you think about the defense, they're very much tied to government spending, okay? So right now, the power is, to some degree, with the buyers, right? That tends to mitigate their ability to make money, because if the customer doesn't want to spend the money, then they're not going to make, I'm going to take my missile somewhere else. Can't go do that, right? So the buyers have a lot of power in this industry, right? What's also been hurting them in the short term is the suppliers. Inflation has really hurt this industry, both on the defense and the aircraft side. So suppliers have had more power because of inflation. That's kind of depressed industry spread, and to some degree RTX's spread, okay? Now the barriers to entry are very high in the defense business, because basically in the defense business, you had to have cleared workers to work with the government. And if you don't have cleared workers, they're not going to let you work with them. So random companies can't just show up and start selling military aircraft. Not going to happen. So therefore, barriers to entry are high, which is favorable to the industry. Not helping them now, but it is favorable. And substitutes. There's not a lot of substitutes for a lot of what they sell. So that tends to work in favor of the industry. But what is hurting the industry right now is rivalry. Because the government right now, their budget, they're talking about flattening defense spending, it's creating more rivalry, okay? And what that means is that the rivalry, the buyer power of the single customer who's spending less, we're talking about spending less, and this inflation, that's why there's probably negative spreads today on the defense side. On the commercial aircraft side, second and third biggest customers, Airbus and Boeing, okay? And from a buyer standpoint, when Airbus and Boeing made less planes in the pandemic, They couldn't sell their plane someplace else, and the parts to the planes weren't being sold as well. So the buyers had a lot of power during the pandemic, especially as demand fell. They also were subject to the same supply chain issues. So suppliers had more power because of the inflation. Right? Barriers to entries are high. It's not like somebody else is going to randomly sell an approved 737 that people are going to buy in mass. Right? So that tends to help RTX because they are doing kind of a captive supply chain. But the other side of it is that rivalry was stronger during the pandemic because with fewer planes, everybody wanted to stay on the plane. They had to do whatever they had to do to stay in the contracts. Rivalry was a little bit more intense, and barriers to entry are high. Again, substitutes, not as many substitutes to planes. So therefore, that's why it was kind of a tough business. You then had to talk about 5 years from now. Okay? Here's where you're going to have some divergence, but I'll give you my quick point of view. On the defense side, I believe there's great power competition between the U.S. and China right now. Right? Better or worse, we don't like each other. On the military side, we are spending more. I don't think there's going to be a war, but it does mean more spending. And I think that will be favorable to companies like RTX and the defense industry. Okay? So in terms of buyer power, government's going to spend more. That's going to switch some of the power to some of the suppliers. I think inflation is going to come under control. So I don't think the suppliers are going to have as much power over the next 5 years. I do think the barriers to entry remain high. I do think substitutes remain low. And therefore, because there's more dollars available, I think the rivalry starts to go down. And that will benefit the industry. Higher spreads in the future. Okay? On the aircraft side, I think in a way similar things. Now that planes are full and people are traveling again and the airlines have recovered, they're buying more planes, which means the suppliers have to supply those planes. So again, the balance is shifting. There's less buyer power because demand is increasing. There's less rivalry because demand is increasing. Okay? Still barriers to entry, still less substitute threat, and with inflation down, supplier power is getting lower. End result is, I think industry spreads are higher long term because it's more favorable economic conditions and more favorable five forces. In terms of Raytheon's competitive advantage, they lack it today. They have their spreads lower, which using numbers, than their two peers, than the industry peers. Here's the thing. I think it's going to change in 5 years. Reason number one, on the defense side, Raytheon's business, RTX, on the defense side, hypersonic missiles, cybersecurity, air defense, right? Missiles, radar systems, right? Those things, not just in the war in Ukraine, but in general, are much more going to be spending on in the future. And so I think their business is actually well positioned to what the government's going to be spending on as it increases spending. I think that's going to benefit RTX. And so they're going to go to a more positive spread environment over the next 5 years. Same thing on the commercial side. I think that their business, they make the parts for the 737. As Boeing makes more 737s, they're going to disproportionately benefit from that, right? Even though they have some engine problems today, I think they're going to resolve those engine problems, and their engines are used by the 737, the A320neo. And that's the point. I think longer term, that wave is going to benefit them, and they're going to go back to positive spreads on both sides of their business. Okay? You can have a different point of view, okay? But nonetheless, you had to articulate that point of view when you went through homework through. Questions? I'm going through that fairly quickly. So you had to submit the screenshots, you had to talk about all the sections, had to refer to data and numbers. You got to do the same thing in 2 weeks. The difference is on the company that I give you later today, you're going to do it in PowerPoint format. You're not doing it in writing. But you still got to submit the screenshots, still got to cover all the information, still got to use numbers. 10 minutes. All right, moving on. Did everybody sign the sign-in sheet? Get back here. Make sure you do that. Let's talk about lecture note 2. We are moving from the first section of the class, EIC, to the second content section, historical analysis. Right? Now, here's the thing. When we do valuation, it's all about the future, but we do need a baseline of the past to predict that future off of, and understanding the past will help us with that future. Doesn't guarantee a repeat. But the other thing is that we need to put these historical statements into an economic cash flow driven format. We're going to follow the format that McKinsey uses with McKinsey statements and Modigliani Miller, which basically means to you, you're going to learn a new language. This will be the most difficult part of the class. because you are learning a new language with new formatted statements that you're not familiar with, that are not really taught elsewhere. Okay? Reason why these statements, in my opinion, are better, when you get through the language, you're going to start to realize you get a better understanding of what's going on, and it makes the valuations easier and more straightforward. But we got to get through the process. So what is the process? On the right, this is a graphical representation of Modigliani-Miller. Okay? And so basically what we're going to do, and this is what McKinsey has done, is they've using this framework as the basis for valuation. So here's the simple idea. Operating cash flow plus non-operating cash flow equals enterprise value. So what that means is, this is Modigliani-Miller, is that we're going to separate out the operating cash flows versus the non-operating cash flows. Operating cash flows are the day-to-day revenue and costs associated with selling products and services. Okay? What do you make doing what you do? Non-operating cash flows have value, but they have nothing to do with sales. Okay? I just have miscellaneous things that have nothing to do with sales. Has value, I'll add it together, but they're non-operating. Example, Apple has about $160 billion of cash sitting on its balance sheet. They don't need $160 billion of cash in the balance sheet to make more iPhones. Okay? So that's a non-operating asset. Has value, cash is cash, but it's nothing to do with selling me another iPhone. So we're going to value it separately. Okay, that's Modigliani-Miller. We take the operating value, we have the non-operating value, together they become the enterprise value. Now, here's the other part of this. That enterprise value of any company can be distributed to its investors. Some of it goes to the debt, some of it goes to the shareholders. So that's the point. Since debt holders have priority over shareholders, take the enterprise value, what amount of that cash goes to the debt holders? Whatever's left goes to the shareholders. So enterprise value also equals the cash flow to the debt and the equity holders. These two sides must balance. And that's important to you because in this class, we balance both sides of statements. In other classes, they don't do that. Okay? We will do that, right? Reason number one, if you don't balance these statements, you can make a mistake and not know it. You calculate operating cash flow, you made a mistake in your operating cash flow, you stop. How do you know you made a mistake? You don't. You balance that operating cash flow with the same amount of cash going to the debt and equity holders. If the operating cash flow doesn't equal that cash, then you made a mistake, and you know you did. So as much as these statements are a pain that you're about to lose, this approach makes you less error prone. And as I said, gives you a better understanding of what's happening with the business. So to help you learn this new language as quickly as possible, the next part of this conversation is unique to this class. Okay? Years ago, I used to teach the McKinsey Analyst Training Program. And in 2 days, I had to take all their newly hired analysts and teach them everything they were learning this entire semester. And when they hired analysts, they didn't hire finance and accounting majors. They hired poets, they hired engineers, they hired pre-med, they hired pre-law, who had never seen a finance textbook. And everything you're learning this semester, they had to figure out in 2 days. Okay? So I had to quickly teach them what I'm about to teach you. So in order to do that, I created mnemonics. Okay? And these mnemonics help them do it, and I've been using in this class for years now. It's going to help you learn this language. But it's unique to this class. So if you start doing what I'm about to do, talk to other people, they'll be like, I don't know what the heck you're talking about. Okay? So in this class, Modigliani-Miller, operating cash flows are ones. Non-operating cash flows, we're going to call twos. Interest-bearing debt cash flows, we're going to call threes. Equity cash flows, we're going to call fours. 1 plus 2, operating plus non-operating, equals enterprise value. 3 plus 4, debt plus equity cash flows, equals enterprise value. 1 plus 2 minus 3, that's enterprise DCF. Okay? So the point is, we're going to kind of put cash flows into these categories, labeling them 1, 2, 3, 4. It'll help you kind of keep track of where things go and why they are where they are. This next slide is very important. It's a summary overview of at a 30,000 foot level of what we're going to cover. Okay? And the other big difference in McKinsey's approach is it's a 3-step approach where other people do 2-step approach. So there's an intermediate step that we're going to do that you don't learn anywhere else. What do I mean by that? When we do evaluation, we're going to start with accounting statements, GAAP accounting statements, income statements, and balance sheets. We're going to rearrange them and remap them into a Modigliani-Miller economic format. That's the difficult part, because they don't exist. We're going to put them in that format. Then, once they're in the economic statement format, we'll do the valuations. It's cleaner. What most people do is they go right from the accounting statements directly to the valuation, and they skip the step we're about to do. Okay? So, what is the step we're about to do? Start with an income statement and balance sheet. Doesn't matter which one you start with, you have to rearrange and convert both to the Modigliani-Miller format. Label each of the items on those statements 1, 2, 3, 4s. Anything that's 1 is an operating cash flow. Anything that's 2 is a non-operating cash flow. Anything that's a 3 is an interest-bearing cash flow, interest-bearing debt. Anything 4 is an equity cash flow. Take that process to each statement. Take the income statement. Take anything that's operating, put it onto a new statement called TII, and that is your NOPAT. That's your operating profit. Take anything that's non-operating income from an income statement, put it into a second bucket called 2s on the TII. That's your non-operating income. Take your operating income, your NOPAT, and your non-operating income, add them together. That is something called TII, Total Income Available to Investors, the name of the statement. That TII will equal all the cash paid to the debt holders. Therefore, on the income statement, anything that goes to the debt holders, interest expense, goes into bucket number 3. Anything that goes to the shareholders, net income, goes to bucket number 4. Those payments to the debt and equity holders equals the TII. Both sides will balance. We'll do the same thing when we arrange the GAAP balance sheet. We'll take all of the assets and all of the liabilities that are operating, we will net them together, and that will be called invested capital. That's your operating invested capital. We'll take all the non-operating assets and liabilities. We'll net them together. That's your non-operating capital. Those are your 2s. We'll add the operating capital, the non-operating capital together. That's called TFI, total funds invested. That will equal all of the interest-bearing debt on the balance sheet and all of the equity on the balance sheet, the 3s and the 4s. You add the debt and the equity, you get TFI. That is the rearranged balance sheet. Once we've rearranged the income statement and balance sheet into its economic statement equivalent, TII, TFI, we will then create statement number 3 called CFI, which is the cash flow statement. Cash flow available to investors. Conceptually, cash flow is cash for the income statement minus cash invested in the balance sheet. Income statement minus change in balance sheet equals CFI. We will follow that format 4 times. To get operating free cash flow, we will take the cash flow from the income statement, no PAT, minus the change in the invested capital in the balance sheet, the operating invested capital. That's free cash flow. That's operating free cash flow. That's our 1s. We'll take the non-operating income from the income statement minus the non-operating investments in the balance sheet. That's our non-operating cash flows. That's our 2s right here. Operating free cash flow, non-operating cash flow, CFI, cash flow available to investors. We'll then take our payments to the debt holders, change in the debt, That's your net cash flows. We'll take, and this is a switch, the dividends we pay to the shareholders, change in equity, cash flow to the shareholders. The debt and equity cash flows will also equal our CFI. These two sides will balance. Once we've done that, we'll then forecast. Forecast all your free cash flows, operating value of the firm. Forecast all your non-operating cash flows, non-operating value of the firm. Add the operating and non-operating value, enterprise value. Forecast the debt cash flow, debt value. Forecast the equity cash flow, equity value. Debt and equity equals enterprise value. We can move across, we can move up and down. Operating plus non-operating is enterprise value, equals the debt and equity, so therefore pay the debt equals equity. This is what I mean by a more straightforward format once we put it in this economic format. Okay? But, and I want to give you a little whiff 'em, what's in it for me, just to give you a sense of this as we get into the conversion in just a couple minutes. What Bloomberg and most of the rest of the academic world calls ROIC, when you put it in this format, you're going to quickly realize is TII divided by TFI. This divided by that. That's what they call ROIC. What we're going to call ROIC is the operating NOPAT divided by the operating invested capital. Okay? So here's the point. What Bloomberg calls ROIC, and you learn in other textbooks, is an average ROIC of the average of the operating ROIC and the average of the non-operating ROIC. You average the two together, you get the average ROIC. Okay? But typically, operating ROIC and non-operating ROIC do not grow at the same rate. That's going to be a problem when we value a company. Okay? And I'm going to give you Apple as an example. Okay? So, in Bloomberg, let's look up Apple. AAPL, US equity. And we're going to go to RV. And we're going to go to custom spread. It's the same spread template we built and used for your EIC assignments. And I know the number's just obvious on the screen to you, but somebody shout out when it pops up, what is Apple's ROIC latest filing? What's the number? What's Apple's ROIC last year? 54.97%. I'm going to round that number off to 55%. Okay? So here's the idea, which we talked about in key value drivers. If you have a 55% ROIC, you're generating 55 cents of cash profit after tax per dollar of investment. If you don't grow that ROIC, then that becomes your value. So here's the point. Take 55 cents, put it into a spreadsheet, 0.55, for 30 years, and DCF it. That's your value, okay? Because that's the whole point. How much cash do they make as an ROIC? That equals free cash flow, proxy. We said ROIC is your proxy for free cash flow, and that eventually will be your value. All right? But here's the challenge. I bought a new iPhone, which is coming to me on Friday, for $1,400. Right? I'm an iSheep, really friggin' expensive. I got the Pro Max, okay? But here's the point. If we value Apple, selling its products and services, that 55% says that selling those phones, they're going to make 55 cents cash per dollar. And if I'm valuing Apple, when they sell more phones, they keep making 55% ROIC. That's what the average ROIC would tell you. Except, they're not going to make 55 cents on a phone. Their operating ROIC, which is the operating profit divided by the operating investment to make the phones, add column, op ROIC, it's not 55%, it's 614%. $1 investment will generate $6 in profit when they sell their products, not 55 cents. And if we value Apple based on their average ROIC, we will undervalue Apple And we will not understand why they're a $3 trillion company. And you might say, all right, why? Why is the average so far off? Because Apple has $160 billion worth of cash on hand. Do you think that they're making 55% on $160 billion of cash invested with a bank? No. They're making 3 to 4%. So Apple is two businesses. They're a business selling phones and iPads and computers that make 600% ROIC, and a business that has $160 billion of non-operating cash making 3 to 4%. And when you average those two businesses, you get 55. But that's the point. They don't need to borrow another $160 billion to sell more phones. So when they sell more products, they're going to make 600%. And over time, the value of Apple is going to increase at a much higher rate than this would represent. That is one of the insights of these converted statements to Modigliani Miller. That's what makes McKinsey better. That's the approach you're going to take. Right? And it's not a secret, because I told you earlier, there's a couple schools that teach this. You're one of them. The other one's Wharton. Okay? The reason why Wharton grads are so respected and go to Wall Street is because they're given a more sophisticated approach than the average finance major. You're getting access to that. I also told you that the McKinsey book is the Bible, which exists on pretty much every practitioner's player on Wall Street, which means the people on Wall Street have figured this out too. These are the more sophisticated funds. They know that operating and non-operating grow at different rates. Most people aren't taught that. And what I'm telling you is this will make you better, right, at what you do. But in order to do that, the accountants don't give it to us in this format. They give it to us in the average format. And you might say, why doesn't Bloomberg change? And the reason is why I'm such an old geezer. I feel younger than I am, but here's the point. I went to Wharton in the 80s, 1980s, long time ago, right? And back then, that's when Bloomberg was getting started. And back then, when they calculated the formulas for ROIC, which haven't changed in 40 years, they basically did average ROIC because companies didn't have huge amounts of non-operating assets. There was no company in the world that had $160 billion of cash just sitting in a bank unpaid out. It was unheard of. If you had a huge amount of cash, you paid it out. You didn't keep it on your balance sheet. You didn't hoard cash. So the point is, there were very few non-operating assets. We didn't have joint ventures where companies invested in everybody else, particularly in the tech industry, where they make more money, like SoftBank is making more money by investing in ARM than selling products and services to its customers. All this non-operating stuff, product in the last 30 years. So back when they did the formulas, there weren't many non-operating assets. So they didn't worry about it. Operating ROIC and average ROIC were about the same. Some companies, that's still true. Some companies like Apple, it's not true. We need to differentiate, okay? So that's the problem with Bloomberg. Part of what you're gonna have to do is you're gonna have to create in your terminal an operating ROIC custom formula, because it doesn't exist. And that's part of your homework assignment for this week coming up. Right? But I want to show it to you even more specifically. FA, historical statements. I'm going to start out with Apple's income statement. Apple, on their last reported income statement, had operating income of $119 billion. Okay? Given their tax rate, I'm going to be generous with rounding, they got about $100 billion in OPAT. About 119 of operating income, after tax, $100 billion in OPAT. Multiply by 1 minus tax rate. Okay? So here's the point. That's the P in the P over I in the formula. Let's talk about the balance sheet. What does Apple need to invest in, operating-wise, to make its products? Accounts receivable. That's $28 billion. Inventory. That's $5 billion. 28 plus 5 is about 33. Accounts payable. $64 billion. 33 minus 64 is negative 31. They have negative working capital of $31 billion. That's not finance. They don't need financing for that. Property, plant, equipment. This is where they actually make their products. Property, plant, equipment, $52 billion. 52 minus 31, about 21. That's their operating invested capital, approximately. There's a couple other minor things in here, but that's the point. They got 20 billion of invested capital. Okay, so $100 billion of profit divided by 20 billion of invested capital. A couple other tweaks. That's how you get 600%. All right, I know in a very simplified version we're at 500%, but they got a few other things that are adjustments. But that's the point. Right? And if you think about their balance sheet, you're like, well, gee, how did they come up with 55% ROIC? Because if you just take all the debt and the equity, here's their debt, 110 billion. Okay, that's their long-term debt. Short-term debt is 11. So what's that? 11 and 110, called 120. Plus equity, 65. 120 and 65 is about 185-ish, 190, somewhere in that range. 100 of after-tax profit, approximately 190 of debt and equity. That's a 55% ROIC. That's what Bloomberg's calculating. There's nothing wrong with their math. They got it exactly right. They took the after-tax profit, EBIT after tax, and they added the debt and the equity, and that's 55%. What I'm telling you is that's an average. That's an average of all the assets, because that's what the debt and equity equals to. If you look at the operating assets, they're making 600%. What's the other average that brings them down? It's right here. Show it on this page. Key stats, cash, $169 billion. That $169 billion is not making 55%. That $169 billion is making 3%, 3.5%, whatever it is. But that's the point. 3% on 169 billion, 600% on 20 billion of investment. That's the 55% ROIC. Everybody with me so far? That's what I need you to understand. That's what we're getting to when we rearrange statements. So let's talk about rearranging statements. Questions about any of this? All right. So that's this slide. That's a graphical representation of what we just went through. The version on the left is what I call traditional ROIC. It's what Bloomberg uses, it's what textbook teach you. Return on the debt and the equity. I'm saying there's anything wrong with that. It's just an average. And what you're going to realize in Modigliani-Miller, TII divided by TFI. It's the average. Okay? But what we're going to do is we're going to say, what if the average is not average? Meaning, what if operating and non-operating have completely different returns, like Apple? Then I'm going to value them differently. Because the operating grows at one rate and the non-operating grows at a different rate. And I'm telling you, at Apple, they're not going to keep adding $169 billion worth of cash to sell the next $300 billion worth of products. It's not going to happen. So they're not going to grow that at the same rate as their sales of products. So that's where we're going to value this one. Again, questions, comments about this? Make sense? Yes?
So this recommendation is like either post-tax divided by that part?
Yeah, exactly. And I'm just looking at the operating side. What's actually happening on the left-hand side that I kind of overlooked just for simplicity is there's also a non-operating component to that. So here's the idea. Debt and equity is all assets minus non-interest-bearing liabilities. That's traditional. Our version, operating at debt and equity is the operating assets minus the operating liabilities. Non-operating assets, non-operating liabilities. Take the non-operating profit on the non-operating investment, the operating profit and the operating investment, average them together. So it'll average the same number. It's just we're splitting out these two pieces on the operating side. Right? We're not splitting the debt and the equity. That's still the same. Okay? But the return of the debt and equity is an average. All right, so how do we do this? This is homework 4. The book explains this in the reading with a very simple example. Let's go through the simple example in class. On Elms, there's a file in the files folder called conversionvideostart.xlsx. Okay? I would strongly recommend downloading that file if you want to follow along with what I'm going to do, because we're going to build it based on the book's examples. I'll post that later today, my finished file, but if you're trying to follow by doing it yourself, because you're going to have to do this for real for your next homework. All right, so let me open up the file. All right, so in the book's example, which we're going to go through, there's a very simple income statement and balance sheet. Okay, this is the simple balance sheet, this is the simple income statement. Okay, now, here's the point. Doesn't matter which statement we do first. Got to do both. All right, in our today class example, we're going to start with the balance sheet first. This is Joe's process, Professor Joe, that I'm going to recommend start with the labeling. The labeling will help you. 1, 2, 3s, and 4s. Operating items 1, non-operating items 2, debt 3, equity 4. Cash, we're going to label that a 1, operating. However, I'm going to put an asterisk by that. Not all cash is operating. Some cash is operating, some cash is non-operating. Right? Think about Apple. We just use that example. They don't need $169 billion of cash to run their business. That's non-operating cash flow. In this class, we will call it excess cash. Excess cash is literally that. It's the cash that's excess that you can pay out. It's non-operating cash. However, every company, including Apple, has to have some cash to run its business day to day. You got to have cash to make payroll. You got to have cash to pay suppliers. You got to have cash to pay the accruals. There's a day-to-day cash component that could never be paid out. That is what we're going to call operating cash. So going forward, some cash is operating that can never be paid out. Some cash is non-operating, which can be paid out. The example they use in the book, they treat it all as operating cash. But realistically, for a real company, we're going to have both. And it will be on your assignment next week. Operating cashes are 1, non-operating cashes are 2. By the way, when I work with real companies, I just ask. I'll ask the CFO, the treasurer, or the controller. I'll just say, how much cash do you need to run your business day to day? They know. When I was a CFO, same thing. I knew when I needed to keep day to day to pay the bills, and I knew that that was cash that I could never pay out. In fact, go to bankruptcy, and I'll tell you the flaw in net debt. Even in bankruptcy, you can't pay out all the cash on hand in a bankruptcy filing. The court's going to take some for the lawyers immediately. They're going to slice that out the top. They're going to pay any unpaid taxes, and payroll's going to be made for any unpaid payroll. Those are going to be paid out before debt holders see dollar number 1. So net debt is an academic concept. It's not a real world concept because you can never pay out all of your cash. So that's the point. Operating cash is the cash that can never be paid out. All right, so but for this simple example, it's called a 1. Inventory, operating or non-operating cash flow? 1 or 2? It's 1. It's what I use to sell my products. Net property, plant, equipment, the building that I make the inventory in. Operating, non-operating. It's operating. It's 1. Equity investment. I own a stake in another company that I don't control. It's a passive stake. Operating or non-operating? Non-operating. 2. Has value, but I don't run that business day to day. It's nothing to do with my current sales. I don't sum the totals. Accounts payable. I owe suppliers for my inventory money that I haven't yet paid them. 1 or 2. Operating liability, non-operating liability, or interest-bearing liability. It's a 1. It's an operating liability. Interest-bearing debt. I have bonds I owe bondholders. Operating, non-operating, interest-bearing. It's 3. Retained earnings. I owe shareholders money that I've kept in the business. That's a 4. That's the equity. So very quickly, we have labeled our very simple balance sheet. Now, to do your assignments, every rearranged statement will be a new worksheet in Excel. Create a new worksheet, call it TFI. This is my rearranged balance sheet. We're going to start copy and pasting. I need to do the same years, so starting in B1 equals from the data, B1 to D1, just copy and paste it over. Now, here's the thing. I then, on my balance sheet, back to Modigliani Miller, I want to take all of my ones, net them together, assets and liabilities to get my invested capital. So I start out with all of my assets equals assets, cash, inventory, and PP&E are my three ones. On my liability side, accounts payable is my only liability one, AP. Invested capital, also known as operating invested capital in our words, is the assets, the cash in this case, plus the inventory, plus the PP&E, minus the liabilities. 380 and 440. That is my operating invested capital. I will try and use the word operating invested capital, but I get lazy like everybody else to just call it invested capital. But in this class, what we call invested capital is different than other classes because they don't differentiate operating and non-operating. We do. Okay? That is our operating invested capital. Assets, net, and liabilities. We are going to do the same thing for the non-interest bearing, for the non-operating. But here's why I like to label. Okay, you're like, why does he do this labeling process? First, it helps you put things in the right place. Okay? Because if I put it in the wrong place, my statements are going to look right. And your biggest challenge when you do these conversions is you're going to forget something. Because I make you balance, if you forget a line item and you don't put it in the converted statement, your statement will never balance. So for example, how many ones do I have here on my sheet? 4. How many ones were on my data tab? 4. I probably didn't forget anything. If I have 4 on my data tab, but I only have 3 on my TFI, I probably forgot something. So it also helps you when you start moving these things over to make sure you don't forget something. Because when it's 1 a.m. and you're bleary-eyed, and there's a lot of numbers, you're trying to figure out what the heck is wrong with my balancing, you'll appreciate this. Okay? Second, let's take our 2s. Any asset 2s equals, in this case, my equity investments. Any liability 2s, we don't have any. We could, we will in the homework assignment. We don't have any here. Net them together just like the working capital. This would be our non-operating capital. In this case, it's just the 15 and the 25, nothing to net them against. So, what is our TFI? What is our total funds invested? Our TFI is the 380 of operating invested capital plus the 15 of the non-operating capital, 395 and 465. Operating is non-operating TFI. That must equal the financing. Also is the funds flow. Equals any debt. Well, I have interest-bearing debt, any 4s, any equity. Retained earnings is my only 4. Add up my debt and equity. Equals 225 plus the 170, 395, and 465. Statement balances. That is what I mean by balancing. In this class, if you turn in any statement that does not balance, you will get no credit. No partial credit. It's an invalid statement. Okay, that's your TFI. Questions? Yes?
Do we have to format it in a special way, or is this fine?
This is fine. What I'm more interested in, the TAs are going to be more interested in, did you get the right things in the right categories and get them to add up? Okay? But let me rephrase. You have to put it in the Modigliani-Miller format. You have to put it in the 1, 2, 3, 4 sections. Okay? All right. I want to save. Statement number 2, TII. This is the rearranged income statement. Total income available to investors. Same process. Starting with B1 equals prior, current, and label, just how the years carry across. All right, so on the income statement, same concept. Let's label all of the items. Revenue, do you think that's operating or non-operating? Revenue from customers, operating, non-operating. It's typically operating. Operating costs, that's easy, 1. Depreciation, operating, non-operating. I'll give you a hint. The item on the income statement has to match the item on the balance sheet. Where does depreciation come from on the balance sheet? The PP&E. We call that operating, therefore the depreciation is also operating. We don't worry about the sum categories, so skip operating profit. Interest expense. That's going to who on the balance sheet? Interest expense goes to who on the balance sheet? The interest-bearing debt. It's 3. It's debt cash flow. The equity income. This is the income that belongs to the passive investors. We made from passive investing. Where'd that come from on the balance sheet? That's a 4, right? Because that came from equity on the balance sheet? No, it didn't. It came from the equity investments. The equity investments generated equity income. Non-operating investment, non-operating income. It's a 2. Tax, trick question. It's a 1, 2, and a 3. We're going to split the tax out to each of the areas that it's impacted on. Net income, that's a 4. That's what belongs to the shareholders. TII stops with net income. That's when you rearrange it, you stop at net income. Down here, dividends are listed. Dividends are the cash flow. Net income is not the cash flow to the shareholders. When we get to the CFI, we will use the dividends. When we rearrange the TII, we stop at net income. Common dividends are a cash flow to shareholders. There are 4. All right, statement number 2. Now that we've rearranged these, we're going to move over operating items on the income statement. I don't like shortcuts, but here's what I'm going to let you take. Everything above operating income, operating profit, is operating. So I'm going to be lazy, and rather than putting all 3 line items, revenue, operating costs, and depreciation, we're just going to start with operating profit. Okay, I'm not going to trick you on your homework, but that's the idea. So instead of putting 3 items, we're going to do the sum of the 3, our operating profit, when we do our NOPAT. And essentially, that's our 1. So here's the point. If we make $280 million of operating profit and our tax rate is 25%, we are going to have to pay tax on the operating profit is the 280 times the 25%. 70. Okay? These would be our operating profit ones. This would be our operating tax ones. This is our NOPAT. Now, we're still going to end up with the same taxes that we paid on the original income statement of 66. We're just going to spread out the impacts into 3 areas. So the operating part of the taxes is 70, and our NOPAT is the 280 minus the 70, 210. Next, I want to do my non-operating profit. My non-operating profit on the income statement, I've labeled a 1, is my equity income. That's 4 million of 2. If I reported 4 million of equity income, my tax on the equity income, I would take my 25% tax rate. So take 4, multiply by the tax rate. I'd pay 1 in taxes. That's my non-operating tax impact. And my after-tax non-operating income, or after-tax equity income, is 3. Now, if I had more equity incomes, I would put them below this, same idea, including the tax impact. But here's the idea. If I take my TII, I will take my operating, 210, plus my non-operating income of 3. I have 213 million of total income available to distribute to my investors. That's my TII on the rearranged statement. Now, here's another thing that's different than GAAP. Okay, what you learn in accounting is going to screw you up. It's not accounting. It's Modigliani-Miller. Format of the statement. If I have income, both sides have to balance. The distributions to debt and equity holders had to be 213. Not negative 213, positive 213. Okay, they gotta be equal to each other. In order for them to be equal, the format of the statement is the other side of the statement called financing or funds flow. Payments to investors are positive numbers. If I have 213 million to distribute, then the distributions are positive numbers. I have 213 in positive distributions. If I lost money, negative income, then I would need to borrow money from my investors to sustain the business. So cash coming into the business is negative on the funds flow side. Cash going out of the business is positive on the funds flow side. If I have income, I pay it out, positive number. If I have losses, got to go find the money, negative number. That's the format of this statement and the CFI. So, my 3s. What am I giving to my debt holders? On the income statement, I'm paying my debt holders $20 million. That's my interest expense. But I just told you, that's a payment to my debt holders. I'm giving them $20 million. On this side of the statement, that's a positive number. Change the sign. I would then have a tax shield because I could deduct this 20 million as a cost of doing business, and I would save 20 million times 25%. I'd save the tax rate. Because I could deduct it. It's interest tax deduction. So I would save 5 million as a tax shield. Companies can write off interest as a cost of doing business. So my after-tax interest expense is 15. Next, that's my only three. I go to my fours, which are already after tax. I made net income of 198. I pay 15 to the debt holders after tax. 198 is available to the shareholders. Threes and fours. 213. I made 213. I distributed 213. On the income statement, I made 210 from operating activities. I made 3 from non-operating activities. I made a total of 213 overall. I then distributed 15 to my debt holders, and 198 was available to the shareholders. I distributed 213. 213 equals 213. Balancing statement. Questions? I told you that everything still has to work out to the same numbers. So here's the idea. On the original statement, we paid 66 in taxes. We still have to pay 66 in taxes when all is said and done. What happens on our rearranged statement? Operating taxes were 70. Non-operating taxes were 1. 70 plus 1, 71. We save 5 on the debt shield. 71 minus 5, 66. So we're going to pay the exact same amount of taxes. We just put it into the areas that are impacted those taxes by. The operating taxes, non-operating taxes, debt, tax shield. They still add up to the total taxes paid. Asterisk. In the 7th edition evaluation, McKinsey stopped doing it this way. In all the previous editions, and most of the time when they work with their clients, they do it this way. But in the 7th edition of the textbook, they don't do it this way. Here's the slide from the book. You'll notice that here on the rearranged income statement in the book, it's 4, it's not 3. That's an error. I called McKinsey, called David Wessels, my friend, who's been editing these chapters. I said, Dave, what's up? Why'd you switch? And the honest answer was, it's too complicated for real world companies to implement. That the real world approach is to make it simple for companies, and moving the taxes into these separate areas was just too hard for companies to do. So they stopped doing it, okay? And they recognize that that's technically not correct. You guys are smart. I'm gonna make you do it. So we're diverging from the 7th edition of the book, and we are putting the taxes in each of the areas, which is true Modigliani Miller. Okay, so I just want to let you know, that's why there's an old TII, and a new TII, because in editions 1 through 6, they did it right. In edition 7, they took a shortcut. Okay, we're not using the shortcut. All right, now that we've done the income statement and the balance sheet, we do statement number 3, which is the one that's going to give you most difficulty with, which is the cash flow. That new tab called CFI. All right. Here's the thing. Relative references, starting out with B1 equals, same off the data tab, prior current label. And here's the idea, conceptually. We are going to take, I told you earlier, no plat, income statement, minus, income statement minus change in balance sheet equals cash flow. That's a process which we're going to do 4 times. We're going to do 1 for operating, that's free cash flow. We're going to do 1 for non-operating, income minus change in balance sheet, non-operating cash flow, income minus balance sheet. We're going to do that for the debt cash flow, and we're going to do that for the equity cash flow. So that process 4 times. That's your CFI. So let's start out with free cash flow. From the TII, the operating number is our NOPAT. That is the operating item from the income statement. It's our 1. However, that's not the cash flow. Ooh. So here's the problem. In that notepad is depreciation. Depreciation is a non-cash item. So if we're trying to do a statement of cash flow, we can't include non-cash items. So the gross cash flow is what it's called. We have to add back the depreciation. So it's our notepad adding back the depreciation of 20 and since we're adding it back, I'm going to flip the sign here. It's formatting. And that's going to be called gross cash flow. That is the cash coming from the income statement. So it's going to be our 210 plus the 20. So we're going to generate 230 from cash for the income statement. Okay? Now, the gross investment, which is the operating cash invested in the balance sheet, is the change in the operating invested capital. So we take from the TFI the operating invested capital this year minus last year. We invested $60 million in gross investment. Okay? But in the shortcut formula that I'm giving you, this year's invested capital minus last year's invested capital plus depreciation. Okay? So we actually gross invested 20. We'll click down in a future class about why we're adding the 20, but that's the formula. Yes? Change in invested capital plus depreciation. That's your formula. Current year invested capital minus last year's invested capital plus depreciation. That's your gross investment. Okay? The difference between the gross cash flow and the gross investment, free cash flow. Free cash flow is the 230 for the income statement, the 80 reinvested in the balance sheet, 150. This formula, change in invested capital plus depreciation. All right, so we made 150 of operating cash flow in the business. Then we go to the non-operating cash flow. Same concept. From the income statement, how much cash do we generate? TII. We made $3 million of after-tax equity income. What is our reinvestment in the balance sheet? In the balance sheet, off of TFI, our equity investment went from 15 to 25, which means we made a $10 million increase in the equity investments. Okay? And I'm trying to figure out my non-operating cash flow, which is going to either add to or subtract from my CFI. So here's the point. I made $3 million of cash, non-operating. That adds to my cash balance. But I spent $10 million buying some other company that I don't control. That's going to reduce my cash balance. So my non-operating cash flow is going to be -7. And then you got to make a choice. I'll let you make your own choice. You either take the 3 minus the 10, or I like to add things together. I just make this a negative cash flow, -10. But either way, my non-operating cash flow is the 3 minus the 10 I invested in new equity investments. I had -7 in non-operating cash flow. So the total cash flow I generated from operating and non-operating activities that I can pay out, which is known as CFI, is the 150 of free cash flow minus the 7 of non-operating cash flow. It's 143. That's the cash that I can distribute, just like the TII. except now I'm tracking cash, not income. Questions about that? Make sense? All right, now we're going to do equity. There are two tricks to equity. If you don't realize there are these two tricks and then pay attention, you're going to really struggle with this on all your assignments. Trick number one, I hinted at this earlier. Debt cash flows equals from the income statement. This is my payment to the debt holders, the after-tax interest expense. And the change in the debt. So here's the idea. My debt went from 225 to 200, which means I paid off 25 million to my debt holders. That is a distribution to the debt holders. On the CFI, just like the TII, payments to the debt holders, just like interest paid to the debt holders, is a positive number. I got to flip the sign. Whether the format is positive or negative on the income statement, you got to just think about the direction of the cash flow. If it's an outflow, it's a positive number on this statement. If it's an inflow, it's a negative number on this statement. Paying off my debt is an outflow. Paying interest is an outflow. Okay? Now we go to the trick. What is the cash going to the shareholders from the income statement? It is not the net income. So trick, it's the dividend, not the net income, that is the cash flow to the shareholders. So dividends. This company paid 103 in dividends. That is a cash going to the shareholder. That is a positive number. Change in equity. My retained earnings, 170 to 265. Just like the debt, I'm going to flip the sign because I increased it. That's an equity cash flow. So now when I sum these four up, I should get a balancing statement. And that should equal to 143. Does it equal 143? No, it does not. There's an error in the statement. Maybe I got the sign wrong in the change in the equity. Let me make this a positive number. Nope. Here's the thing. Trick number two. Retained earnings is a non-cash account. A change in a non-cash account has zero impact on cash flow. Retained earnings is not part of this statement. If you try and put it there, your statement will never balance. And you'll go crazy trying to figure out why. So two important things when you get to equity. Dividends, not net income on this statement. On the TII, you stop at net income and don't include the dividends. And change in retained earnings is not part of the change in equity. The change in equity is you issue new stock or you bought back the stock. That's a change in equity. That's cash flow. But change in retained earnings has no impact on cash flow. That's the balancing CFI. Statement number 4, economic profit. Economic profit, also known as EVA or economic value added. EVA is trademarked by the consulting firm Stern Stewart. Nobody can use it. The generic term is called economic profit. It represents a one-period change in value of a firm. Here's how you calculate it. Two methods. Equals. Do my years, prior current label. You start out with a spread. I take from my income statement, TII, my NOPAT. I take from the TFI, my invested capital. If I divide by NOPAT by invested capital, I get ROIC. Okay? Except on your assignment, I'm going to ask you to do a BOY ROIC. BOY stands for beginning of year. I'm not going to ask you on this assignment to do an EOY ROIC, which is end of year. What's the difference? Beginning of the year ROIC is the current year NOPAT divided by last year's invested capital. That would be 55%. If you had done end of year, and you won't get credit, 210 divided by 440 is 48%. Okay? For this assignment, current year NOPAT divided by last year's invested capital. Okay? That's beginning of year ROIC. I'm going to give you a whack. Let's say it's 10%. Give it to you as an assumption on your assignment. The difference between the ROIC and the whack is called the spread. The spread equals the ROIC minus the whack. We have about a 45% spread. Here's how economic profit works. Take your spread, 45%, take your beginning of year capital, 380. I created 172 in value this year. I did 45% better IRR than my R, and that times the dollars is the dollars of value I created with that IRR. That's called economic profit. Method number 2, I made NOPAT of 210 million. I have something called a capital charge. Which is if I have 380 million of investment at the beginning of the year and I have to earn 10% on it, I need to make 38 million to pay you back 10%. If I made 210, the difference between the 210 that I made and the 38 that I needed to make is 172 million of economic profit. That's the balancing EP. Economic profit, also known as EVA, economic value added, is a one period NPV. Spread method, spread times capital. Dollar method, NOPAT minus capital charge. Those are the 4 statements in your homework assignment. Okay, 1 more minute. So here's the idea. Your homework assignment, which has been posted for homework 4, due 1 week from today, is a conversion. This is the file you're going to download. It says homework 4 on it. It is very important that when you do this assignment, you turn in this file with 4 new tabs. Using a different spreadsheet, not this spreadsheet, will not be graded invalid assignment. You have to use the file I give you. Turn it back in. No sharing, you gotta do this yourself, and I'm giving you the labels. You don't have to label for this assignment. Looks intimidating because there's more categories, but if you follow the label process, you're just copying and pasting columns, it'll go by smoothly. If you struggle with this assignment, TAs have office hours on Tuesday or Thursday and Friday. Take advantage of that. Finally, Wednesday, Bloomberg Lab Day, no lecture. I'm giving you time to not only work on this assignment, to work on your group project, which is due in 2 weeks. I'm going to start to get the data for that. And You have to calculate an operating ROIC in future assignments. You're going to have to create an operating ROIC in your Bloomberg account. Use Wednesday's class time to do so. I'll post a short video on how to do that. That's another assignment that's due this week. So you're going to create a custom operating ROIC in Bloomberg, and you're going to convert these statements into these 4 economic statements. I'll see everybody 1 week from today, next live lecture. Where is the sign-in sheet? Make sure you sign the sign-in sheet before you leave.